Imagine moving abroad, marrying a local entrepreneur who built a thriving business, and then finding out the IRS expects you to report and potentially pay taxes on their profits. If you are a U.S. citizen or green card holder living abroad and your spouse is a non-resident alien, meaning a non-U.S. citizen living outside the U.S., you are standing in an international tax minefield. Please note this video is for educational purposes only and is not a tax advice. By marrying a non-resident alien who owns foreign businesses, you are standing on an international tax minefield. It all starts with how you file your taxes. By default, you file as married filing separately. Your spouse's income stays completely invisible to the IRS. But many expats fall into the trap of making an IRC Section 6013G election to file a joint return, thinking it will save them money in a lower tax bracket. But here's the catch. The moment you sign a joint return, your non-U.S. spouse is treated as a U.S. tax resident. Their worldwide income and every single asset or business they own overseas is now fully exposed to the IRS. But what if you didn't file jointly? What if you choose married filing separately and you legally own exactly 0% of your spouse's business? You're safe, right? Wrong! This is where the IRS invisible wire trips you up. Because of constructive ownership, also known as family attribution rules under Internal Revenue Code sections 318 and 958. Under these strict rules, the IRS legally attributes the stock owned by a foreign spouse directly to the U.S. expat spouse. Even if you don't own a single share, do not work there, and have no access to the bank accounts. The IRS looks at you and deems you a constructive owner of that company. Historically, this was heavily penalized. If attribution rules push U.S. ownership over 50%, the business suddenly transformed into a controlled foreign corporation, unleashing waves of aggressive corporate compliance and tax liability under Subpart F and GILTI laws. Fortunately, recent legislation like the One Big Beautiful Bill Act has begun dialing back some of these extreme downward attribution penalties, but the reporting traps still remain. These are highly complex tax rules. Seek professional help to discuss your own situation. So what happens if these attribution rules flag you? You meet the dreaded Form 5471, the information return of U.S. persons with respect to certain foreign corporations. Failing to file this form when required triggers an automatic flat $10,000 penalty per year per corporation, even if no tax is actually owed. But don't panic just yet, because there is an incredibly vital safe harbor hidden in the tax code. Under Treasury Regulation Section 1.6038-2L, the IRS provides a filing exception. If your requirement to file Form 5471 is triggered solely because of constructive ownership from your non-resident alien spouse, and you do not directly or indirectly hold any physical stock in that company yourself, you are generally exempt from having to file the form. It's a massive sigh of relief, but you must satisfy the criteria precisely to claim it. To keep your household safe from unexpected IRS audits or five figures penalties, you need a clear, proactive defense strategy. First, keep your business assets perfectly segregated. The U.S. citizen spouse should never accept a token 1% or 5% share of the foreign spouse's company just because. Doing so completely shatters your safe harbor protection and forces you into full Form 5471 reporting. Second, avoid corporate signing authority or directorships on your spouse's business accounts if you can avoid it, as this can trigger separate FATCA or FBAR reporting thresholds. Finally, default to married filing separately. Unless an international tax professional runs the math and proves a joint return saves you significantly more money than the cost of complex corporate compliance, keeping your tax identities separate is the safest move. U.S. international tax rules are complex, and your facts matter. Please consult a qualified tax professional before making a filing decision.